Hi traders, welcome back to this Blueberry Market Academy video, advanced part 1. Today we're going to be diving into some key topics and we'll learn about market sentiment, trade in the news, commitment of trader reports, and seasonality. Now, market sentiment is essentially the overall attitude of investors towards a particular security or financial market. It plays a significant role in driving currency and security prices, often in response to the news. Now, these tools provide a sense of how investors are feeling about the market, bullish, bearish, or neutral. Now, tracking market sentiment can be done using various tools, and as an example here, I've got the Fear and Greed Index. The Fear and Greed Index is a compilation of 7 different indicators that measure some aspect of stock market behavior, and they include market momentum, stock price strength, stock price breadth, put and call options, bond demand, market volatility, and safe haven demand. The index tracks how much these individual indicators deviate from their averages compared to how much they normally diverge. And the index gives each indicator equal weighting in calculating from a score of 0 to 100, with 100 representing maximum greediness and 0 signaling extreme fear. Now, to put it in plain terms, this looks a little bit like it's, unhelpful in a way. However, what it's basically showing us is how far something has moved from a particular average. So, for instance, this is actually given us from the S&P 500, and that was last updated on July 14th. Now, what it basically is showing us, if you were to put a S&P chart up here with the 200 moving average, basically measures how far away we are from that 200 moving average, and then develops to say, well, extreme greediness means that the market is very bullish at the moment. However, could get to a point where it could reverse from an emotional standpoint, from a feeling standpoint. So that's just something to consider there with regards to market sentiment and the Fear and Greed Index. Moving on to trade in the news events such as political occurrences, economic indicators, social events can significantly impact the markets, and traders use this information to make informed decisions and to anticipate potential market volatility. For instance, let's have a look at the example I've got here of non-farm payroll. This event had a significant impact on the market, and you can see why, because what we saw was the non-farm employment change grew from 165,000 to 253,000. We also saw average hourly earnings move from spot 3% to spot 5%, and unemployment rate declined from 3.5% to 3.4%. And you can see via this euro US dollar chart I've got here that actually price spiked lower on that news and dropped quite significantly into a key area after that news event. So basically showing us how this information can impact that particular market on that day. The commitment of traders reports. So what are the commitment of traders reports? Now, these reports provide a breakdown of open interest for futures and options on the futures markets, and they offer valuable insights into the actions and trends of major players. So, we have main categories on the commitment of trader reports. Those are the commercial traders, non-commercial traders, and non-reportables. Now, the commercial traders are in the markets for business purposes and are often buying as currencies or commodities weaken, or if you see currencies, commodities gain significant strength, they will be selling as it's for business purposes. The non-commercials, however, are in the markets to make money and are often considered trend followers. Now, these are your sort of hedge funds, large investment companies, things like that. They are the non-commercial traders, and that's who you typically want to follow in the markets. Now, we also have the non-reportables. Non-reportables are players in the market that aren't big enough to be recognized, such as small investors, people like us in terms of retail traders. So we are too sort of small to be recognized essentially as an entity. Now, this breakdown gives us a bit of an understanding of what different types of traders are going to do and helps us spot potential market opportunities. Now, the commitment to trader reports are actually free and can be downloaded from the CFTC or Commodity Futures Trading Commission website. So, like I said there, if you want to get this detailed report that comes out on a weekly basis, it's usually every Tuesday in the US, you basically can download all that information for free and see where these market participants are positioned. Now, I've got a report here, which is the price of gold. Below, I've got the commitment of trader data that's just been plotted on a line graph, which gives us a nice visual representation of what's going on. So the non-commercial contracts are in green, the non-reportables are in dark blue, and the commercials are the red line. Now, if you're looking at gold like we are here, then what I like to look for is the extremes in price. But before I mention that, or before I talk that in depth, what I'll show you is the fact that as prices rally into the upside, like here, for instance, you can see that the commercials are selling more. Again, that's because they're in the market. They are potential producers. They are businesses involved with the commodity of gold. So as gold prices rally, what is a business going to do? They're going to take advantage. They're going to try and sell more of that product, okay, so that they get more for their money, right? What tends to happen then, though, is that they get to a point where the selling outweighs the demand, right? So basically what happens then is price starts to flip as contracts get to a certain point, and once the demand isn't there, price then starts to fade away, and commercials then start to buy more as price decreases, because what they're doing is trying to predict the future and say to themselves, well, if price is falling now, how likely is price going to move higher in the future? Highly likely. So we want to be able to buy as the price of the commodity decreases. Okay, now you've got the non-commercials as well. You can see here non-commercials are trend followers. So as price decreases through there, you can see also the non-commercials decrease as well, because they are basically shorting as price moves lower, because they're in the business of trading. You can see it happens the opposite way here, where as price decreases, the commercials are buying that market. And again, when we get to the point where the demand outweighs, or the supply and demand outweigh each other, and you get that sort of move where contracts reach an all-time high, for instance, you can see looking left, we haven't reached these numbers of buying contracts in a large number of time, then price then reverses and moves higher. As price reverses and moves higher, the commercials are going to begin selling again. So you can use this as a bit of a predictor tool as well. If you get to an extreme with the contracts, you can kind of look and pinpoint that when the contracts are at an extreme over a certain amount of months, then you can see that price tends to follow that with regards to commercials. Now, seasonal patterns, seasonality, you may have heard it called, it refers to predictable changes that occur over the same period each year. And in markets, we often see trends develop around these periods. Now, one common example of this is what we call the Santa rally, and this occurs around about the end of November, start of December, and is based off the seasonal buying ahead of the Christmas holidays. Now, what I've got here is a chart that's been provided by equityclock.com. That is a free website where you can pick up these free seasonal reports, and yeah, you can basically see that in the end of November, December, price rallies. It actually starts to rally on the S&P 500 back in October. This could be the early sort of stages of the what we call the Santa rally, and basically what that is people are buying in their presents, they're buying food, they're basically increasing the demand in the market. They're also basically spending more money in the markets, and that's what causes that Santa rally there, as businesses pretend to profit through those Christmas holiday periods. So that's what the seasonal patterns are about. You can also use it to spot highs and lows and turning points in the markets. Now, in summary, we've discussed the market sentiment, we've discussed trade in the news, the commitment of trader reports, and seasonality. But it's remembered that while these tools and strategies can be really helpful, that you should be using them as part of a larger comprehensive trading strategy, and this way you can take advantage of various opportunities and protect yourselves from potential risks. So thank you for joining me today for this first part of the advanced video series, or the Advanced Academy. Hope you really enjoyed the video, and I'll catch you in the next one.